Alright, so now you have a whole bunch of money saved up and you don't know what to do with it. It's probably sitting in a checking account somewhere just collecting dust. So, what do? How do you invest it? When you think of an investor, do you think of the guy on Wall Street with a nice black suit, maybe a briefcase that's yelling, buy, buy, sell, sell? While that guy may be an investor, the modern investor is actually just like you and me, average AF. Alright, let's get at it. Hi, I'm Matt from Inside Investing, and I'm an investor. And let me tell you, if I can do it, trust me, you can too. There are so many tools out there that make it affordable and easy to learn. But before you get started, you need to ask yourself two questions. How much control do you want in your investments? And how liquid do you need those funds in those accounts to be? Wait, did he just tell us to invest in water? Not at all. But I'm saying, how fast do you need to have access to that money?
So when we talk about highly liquid accounts, we talk about if you can get your money out of the account within 5 business days or so. So I want you to think about your savings account. If you need to get money from your savings account and put it into your checking account, what would you do? You go online and you just transfer it over. I mean, some banks, if you have a bank in a different institution, might require 2-3 business days to get it fully transferred over, but really, that's pretty fast. Or maybe you're okay with leaving that money in an account for an extended period of time where you can't touch it, but it makes great returns. And that is not liquid.
And then there's control, which is how much control you want on your investments. Do you want to just throw your money at somebody and say, here, make me money? I don't want to talk about it. Or do you have a company in mind that you did all your research on the key metrics and you know what stocks you want to get into? All right, let's start off with the most popular one, and that is individual stock trading. But really, how do you do it? Well, that's the easy part, is there's so many brokerages out there that make it easy and affordable for you to do it.
In the past, if you wanted to invest, you had to pay these brokerages commissions and fees just to make one trade. And when I say trade, I mean anytime you went to buy or sell one company shares, doesn't matter if it was 1 share or 10 shares, you'd have to pay commission. What the brokerages use these fees and commissions for is to provide you with an analysis tool, news feed, and other bells and whistles that you may or may not have needed.
Then along came Robinhood, and it revolutionized the way that we were able to trade. They offered 0 commission trades. It didn't matter if you were buying one stock for $1,000, it was free. And that was perfect for the small trader, because $10 commission could be 10% of what you just invested. Now you're 10% in the hole and you just got started. Like I said before, it didn't matter if you were buying 1 share or 1,000 shares. You'd have to pay a set commission, let's just say $10 on that trade. Now if you're buying 10,000 shares, then yeah, $10 is no big deal. But if you're buying 1 share, $10 can be more than the share price itself. But with Robinhood, it didn't matter at all. All trades were free. And the best part is, this was a market disruptor. This created a huge wave amongst all the investment companies that are like, oh crap, we need to do that too. We're losing too many customers to Robinhood. So they started offering free trades for all of their individual trades. But the best part is they kept all those bells and whistles that they used to charge a lot of commissions. And then Robinhood stepped up even further. They started offering fractional shares. Say you wanted to get in with Amazon, but Amazon's trading at $3,000 a share. What if you didn't have $3,000 to start off with? You only had $300. With fractional shares, you can now buy $300 worth of Amazon. So now, instead of 1 whole share, you have 1/10 of a share, right? My math adds up? Also with Robinhood, if you follow the link below, you'll get 1 free stock when you sign up and put money into your account to get your portfolio going. So that really helps too. And more importantly, I really suggest going to InsideVesting.com, where you can read about different strategies when it comes to stock investing, and also the top 5 key metrics that I look at when I'm looking at companies to see if it's a good deal and if I really want to purchase the stock.
So stock investing gives you the most amount of control, so you can dictate exactly where your dime goes. And for that, I give that control score of 100. As for liquidity, you can move money in and out of these accounts within 5 business days or so. So it's not as liquid as, say, your savings account, and because of that, I give it a liquid score of 80. Individual stocks can be risky, but I know what you're thinking. High risk, high reward, right? Well, think of it this way. Investing should be a get-rich-slow game if you want to make consistent results. And for this, with the risk, depending on your risk level, I give the risk score of 80. And to build your wealth, I would say this would give a wealth score of 50. And you might be thinking, with all the hype stocks out there, that you can make millions. But if you think about it, if you put $100 into one of these stocks and it went up 50 times, then you have $5,000. It's not like you were a millionaire because you bought $100 worth of stock. So it is a very slow game. Believe me when I say slow and steady definitely wins the race in this game. The next strategy we're going to look at is investing in mutual funds. So mutual funds are investment pools that are managed by somebody that creates a portfolio of stocks that is all purchased with a pool of money. So what does that mean? What it means is there's a manager out there that compiles a portfolio based on its certain sectors. And the portfolio could be built with stocks, bonds, ETFs, you name it. For example, let's look at the retail sector. I happen to own a mutual fund that is in the retail sector that has Target, Amazon, TJ Maxx, Home Depot, etc.
So within these portfolios, each stock is weighted differently. There might be more Amazon, more Target, and then TJ Maxx. And that's exactly what the manager does, is to make sure you're getting the most bang for your buck. But unlike individual stocks, there is a slight expense ratio when it comes to having somebody take care of your money for you. But typically these fees do not negate all the profits you make by having such a diversified portfolio, depending on the sector that you try to invest in. Of course, with Robinhood's fractional shares, you can build your own portfolio. But there's some people that just don't want that much control. They just want to throw their money into a general pool to diversify and just let it be. But because you can choose the sector that you want to invest in, I'm going to give mutual funds a control score of 75. So like individual stocks, you use a brokerage to purchase mutual funds. And the liquidity is about the same. So I give a liquidity score of an 80. When you buy a mutual fund, you're buying diversity right off the bat. You're diversifying your portfolio. And because of that, I give the risk score of a 60, a little less than individual stocks. But like individual stocks, this is a get rich slow game. And because of that, I'm gonna give it a wealth score of 50.
The last investment opportunity I want to talk about is the retirement funds. So these are like your IRAs, or if your work gives out a 401k or TSP, these type of accounts. The biggest difference with individual retirement accounts and mutual funds is how they're taxed. If you have a Roth IRA, then the money is going into the fund after you've already paid tax on it from however you received the money. If you have a traditional IRA, then all that money is going into the accounts before it's taxed from your paycheck. The difference between the two comes into the end when you go to withdraw the money. If you did the Roth IRA, then it's already been taxed. So now all that money that you made, it comes into your account tax-free. If you chose a traditional IRA, then all that money is being taxed once you withdraw it. So in the end, you could be paying a lot more taxes in your retirement, but you didn't pay as much taxes early on. Also, like the mutual funds, your 401k has different sectors that you can invest your money in. You got the S fund, the C fund, the I fund, or the G fund. These funds have different risk levels and different compositions. So there's only a few of these funds. So that means you don't have much options when it comes to choosing your sector. But unlike mutual funds, these funds have very low expense ratios. These managers aren't getting paid a lot to manage these funds because they know those funds are going to stay in there for a very long time. You don't have much control other than those few sectors to choose from. So I'm going to give the control score of a 40 on this one. You can't touch these till you retire unless you pay a huge penalty, which you probably don't want to do. So I'm going to give the liquidity score a 20. So having these funds in the account for a long time and using dollar cost averaging, your funds are going to continue to go up. So I'm going to say this has a risk score of 30. Investing in a Roth IRA has great potential for great wealth in the long run. And if done right, this is your key to retiring comfortably. So I'm going to give this a wealth score of 60.
And before you jump on me about using your IRAs to invest in other mutual funds, individual stocks, or hell, even real estate, I just want to say this is like more of a general concept. I wanted to make this video to show general investing options of the 3 ways that you can hop into the stock market, not to get into all the little nitty gritty. So there you go. If you want to invest in the stock market, you just got to ask yourself a couple questions. How much control do you want on your investments, and how liquid do these funds need to be? Your risk and wealth potential all depend on you. If you want to be super risky and go for the crazy stocks, then I mean, that's up to you, but you can also lose a lot of money. You just keep that in mind. But like they say, high risk, high reward, right? All right, so what do you think I should talk about next? Please leave in the comment below. Help me continue to make videos that can help people like you. All right, don't forget to like and subscribe. See you next time. You wanted all this whoopity doopity, that was stupid.